Hello and welcome to the quarterly results analysis for Avenue Supermarts. We'll be looking at the results for Q3 FY19. Let us start with the P&L numbers. When we look at the graph on the left, we can see that the company managed to sustain an excellent growth in revenue. For Q3 FY19, the revenue grew at about 33% to 5,459 crores. The surprise this quarter was the growth in expense. Expenses grew at an even higher rate of 36%. I wasn't expecting a higher expense growth. Historically, a higher expense growth has had an impact on the PAT growth. This is highlighted in the graph on the right. In this quarter, as well as in previous quarter, the expense growth was higher than the revenue growth, and clearly the PAT growth was lower for these two quarters. However, in all the other preceding quarters, revenue growth was higher and hence PAT growth was way higher. This can be seen in the Q1 FY19, Q4 FY18 and Q3 FY18 results. Now the EBITDA took a beating due to the higher expense growth. EBITDA grew at a historically low rate of 7.5% to 453 crores, and the profit after tax or PAT took a further hit and grew at an almost flattish rate of 2.1% to 257 crores. This is the lowest that the company has grown in all the quarters since listing. The EPS growth followed the PAT growth at about 2.2%. The graph on the right hand side shows the EPS growth. So the EPS came in at 4.12. The management attributes three reasons for the drop in EBITDA and PAT growth. The first reason, the company took price cuts on the products that it sold. This could be the festival discounts due to the fact that Dussehra, Diwali, Christmas and New Year were all part of the Q3 FY19. And fellow retailers were going all guns blazing with crazy discounts. The second reason, the company front-loaded some of the expenses for future growth. This could include the infrastructure and manpower costs for the new stores that could come up in Q4 of FY19 and beyond. The third reason, higher operational expenses due to longer working hours. Now, due to the festival season, the company took a conscious decision to keep most of its store open for extended hours. This incurs operational expenses. To me, the second and third reasons are acceptable as they are part and parcel of business operations and need not be treated as systemic issues. But the price cut that the company had to take is worrisome. If price cuts were a one-off event, then I'm not really worried. But if this turns out to be a forced event that occurs and reoccurs in Q3 of every year, then I'm not very comfortable accepting this fact. Now there were three contributors to the erosion in EBITDA and are clearly visible when we look at the expense numbers. When we look at the graph on the left hand side, we notice that the major expense for Avenue Supermarts, that is purchase of stock in trade, has grown by a whopping 46%. This number indicates that the company bought lot of items from its supplier in Q3. But when we look at the revenue numbers which are shown just next to it, the revenue grew by merely 33%. So this is a clear indication that the company bought more items but sold these items at lower margins. The graph on the right hand side shows the growth in other expenses. There has been a substantial growth in other expenses in Q3. Other expenses grew at the rate of 45% to 259 crores. This higher than expected growth in other expenses explains the other two reasons for a drop in EBITDA, that is front loading of expenses and operational expenses due to festivals. The company captures the OPEX under the other expense, and so are the costs associated with store employees. If the company had paid its manpower contractors in advance for these new stores, then it would get reflected here. I tried to look through the other expenses for the past 5 quarters. I noticed that this was the first time that the company has seen an expense growth of this magnitude. I did a small computation on a what if scenario. So, what if the expense growth was say 20% instead of 45%? In that case, the company would have seen a savings of close to 45 crores in its expenses. This would have translated to an increase in PAT by about 28 crores. Now, assuming a tax rate of 37%, this translates to a PAT growth of 13.2%. Clearly, the increase in other expenses has shaved off the PAT by close to 1100 basis points, which is a huge number. I was going through an interesting video on NRF 2019, which is a retail show wherein Professor Scott Galloway from New York University was running through his 2008 predictions and how he fared on his predictions. In the presentation, he showed that in US for 2018, Walmart beat all the retailers, both online and offline, to emerge as the largest grocery retailer. The important takeaway for me was the fact that people liked the store pickup concept more than home delivery concept for grocery. Scott attributes this to the fact that most people are not generally at home to pick up groceries. Clearly, the store pickup concept that Dmart is floating around has some success stories elsewhere. In the same presentation, Scott explained that it has been an interesting year for private label business for Amazon. Hitherto, this was a small business as recently as 2017. In the year 2017 and 18, Amazon unleashed 56 private labels, and close to 53 of them are in clothing, shoes, and jewelry segments. This shows that private labels are a margin accretive business. I hope that Dmart takes up private label business in a big way in the future. In summary, revenue growth was a positive development. The PAT and EPS growth was disappointing. The price cuts was definitely a shocker for us. Front loading of expenses is part of the business, and so is operational expenses due to festivals. Overall, this was a rather subdued quarter. I hope Q4 turns out to be a better quarter for the company. This was an abridged version of the results for the company. Please read through the detailed review on investing.amitkirti.com, where we look at some more aspects of the results. Thanks for listening.